Assalamualaikum and a very good morning. So today we're going to learn another new topic on MFRS, which is MFRS 108, that talks about the accounting policies, changes in accounting estimates and prior period errors. Okay, so this is what we're going to learn today, the overall picture of MFRS 108. So we are going to go through one by one. I will start off with the definitions of the respective terms that is included in this MFRS. So to start with, we'll start off with MFRS 108, we will do the definitions of the terms that is provided in this MFRS. So the first term that you need to be familiarized with is the accounting policies. So what does it mean by accounting policies? It's actually the specific principles, bases, conventions, rules and practices adopted by entity in preparing and presenting financial statements. So basically, there are many principles or conventions that you need to know when you want to learn accounting. All right. So one of the principles, for example, consistency. All right. So when we want to prepare our financial statements, the methods or the rules that we have to follow must be consistent. All right. For example, if you have once decided to adopt the straight line method in depreciating fixed asset, then you need to be consistent in using that particular method. All right, we cannot just like change from one method to another method as we like. All right, but it doesn't mean that if we have stick to one method, we cannot change it. We can change it, but upon agreement by the management, and it is being stated in the notes to the accounts. All right. And we also have practices which is adopted by entity in preparing and presenting the financial statements. Okay, so the practices, for example, what are the normal practices that has been used by the entity when they want to prepare the financial statements. Okay, so let's look at illustration number 1. Okay, so let's look at illustration number 1 that is related to accounting policies. All right, so an entity that measures the investment property after initial recognition using the fair value model, because its management believes that the measurement at fair value provides more relevant information. Alright, so meaning that initially when they purchase the investment property, they will record it at cost. Alright, subsequent measurement of the investment property, the company can decide whether they want to choose the cost model or the fair value model. So if you can recall what we have learned earlier on MFRS 140, we have actually learned on the measurement method of investment property. Alright, so now let's say that the management decided that they want to use the fair value model because they believe that it reflects the a more relevant information to the users of financial reports. So whether the question is whether they can use this fair value model, yes, they can. Right? So if you look at the solution here, the fair value model used by the entity is acceptable since it is accordance with MFRS 140 investment property, where the entity can decide to use fair value model to measure investment property, since the management believes that the financial statements will provide reliable and more relevant information about the effect of this investment property on the entity's financial position, okay, and financial performance of cash flow. All right. So this is one example of the accounting policies that in accounting, where the choice that we have decided should be can be used, provided that it is allowed in the or is included in the accounting policies of the organization or the companies. Okay. Okay. Now we go to the next one, that is accounting estimates. So what does it mean by accounting estimates? It comes from the word estimates, means that it is not necessarily accurate, but because it happens for future events, so we don't really know what would be the exact amount. So based on that, it is based on estimation. And normally estimation comes from judgment, right? So if you look at the definition here, judgment applied in determining the carrying value of items reported in the financial statements. All right, for example, if we have a property, plant and equipment, and plant and equipment is chargeable for depreciation. All right, so because it is a practice that for certain company, we have to determine the amount of years that the plant and equipment that we can use. All right, so if let's say that you have a plant and you estimate that the useful life of a plant is 10 years. So when we provide depreciation, so we take the cost of the plant divided by the number of useful life of that particular plant. And then the amount will be chargeable to expenses. Now why do we need to do that? Because we have to use or stick to the matching concept, where we match the expenses that we incurred for that particular period and match that with our revenue that we earn for that particular period. So if we have charged the whole amount of the plant to the expenses account, then that does not reflect the matching concept. So based on that, that is why we need to use the estimation in estimating the useful life of the particular plant. All right. Another example is if you have a vehicle and you expect that the vehicle is you can use that vehicle for about 5 years. All right. So we cannot forever state in the financial statement that the amount of the vehicle will be the same throughout the number of years. So basically, over time, the vehicle will be worn out because of wear and tear, or it may not be able to help us to produce revenue effectively anymore. And because of that, we have to estimate the useful life of the vehicle. All right. Now, if we estimate that the vehicle is 5 years, then we're going to take a portion of the cost of the vehicle and transfer it to the profit and loss account. And again, that will follow the matching concept, all right? Where in accounting, when we prepare the financial statements, all right, we have to match the revenue that we earn with the expenses that we incurred. All right. So let's look at the illustration number 2. An entity acquired a yacht for 1 million on 1st January X1 and apparently assessed its useful life at 30 years from the date of acquisition with a residual value of 100,000. So what does it mean by residual value? Residual value means that at the end of the useful life of the yacht, if you want to sell it or dispose it, would you be adding an amount of money, and that amount of money represent the residual value. Alright, another example that if let's say you have a car, you have used up the car for 5 years and the cost of the car is 10,000, and after 5 years if you manage to dispose it for 1,000, then that 1,000 is your residual value. Now the entity decided that they use the straight line method to depreciate the yacht. Okay, in 2009 the entity undertook substantial research into the yacht industry. As a result, at 31st December 2009, the entity assessed the useful life of the yacht at 20 years from the date of acquisition with a nil residual value. They also assessed a fair value for the yacht as at 31st December 2009 at 800,000. It continued to believe that the straight line method is the most appropriate method of depreciation for the yacht. So when it comes to accounting estimates, so what they do is they have to estimate once they acquire the yacht how many useful life or the life of the yacht that is going to serve for us. Alright, so for the first year, when they first acquired the yacht on 1st January 2001, they estimate that the useful life is 30 years. So 9 years after that, they estimate that the useful life remains 20 years. So when we want, now this changes, right, from estimation from 30 years to 20 years is considered as an accounting estimates. Alright, so if you look at the solution here, the reassessment of the yacht useful life and the residual value are considered changes in accounting estimates. Alright, because first we thought that it's going to be used for 30 years. Then after 9 years, right? So basically the remaining years is supposed to be 21 years of the remaining useful life. But because then they reassess back, they reassess that it's only going to be 20 years. All right. So on what basis do they revise the number of years? It depends on the situation at that time. When they feel that there's new information, probably the market price of the yacht has reduced, then they need to revise. So when they revise, it is based on the new information available at the date of revision. Okay, so that is the revised assessment are appropriately made on the basis of new information that arise from the research performed in the current accounting period. That is, at the date when in 2009, they feel like there is some information that says that the useful life of the yacht has to be revised accordingly. Okay. Now we go to the next one. Next definition that you need to know, that is prior period errors. All right. So what does it mean by prior period errors? Okay. So if you look at the term here, prior means before, period that is the counting period, and errors. Okay. So meaning that if there's an error, possibility what we have done is we probably have omitted or misstated in the financial statement. For example, there's one transaction that we have accidentally omitted from the financial reports. So we have omission. Okay. Or misstatements in the financial statements indicates, meaning that, for example, all this while because of mathematical error. Alright, when we make the casting, probably the total amount is 10,000, but we have accidentally recorded it as 1,000. So there is a misstatement from 10,000 to 1,000. So prior period errors relates to omission or misstatements in the financial statements for one or more accounting period. Alright, now why this has happened? Because of the failure to use reliable information. Alright, we may have, for example, mathematical error. Alright, or we may make mistake in applying accounting policies. Alright, so let's say, for example, when we started recording our investment property, we record it at cost for 10,000. Okay, now let's say subsequent measurement, the management has agreed to adopt the fair value, but the accounting department may have overlooked that decision and continue to adopt the cost model. Right, so when they want to record in the financial statement, they have the question is, how are we going to make or adjust the mistake that we have made from recording of cost model to carrying model. Okay, so this is considered misstatements. Or we may have fraud, all right, done by our officers. All right, so that fraud may cause omission. All right, for example, fake invoices. All right, so that in fact invoices aren't supposed to be in the financial statements, but it has been included. So we need to do that kind of adjustment, right? So we will deal into that later. Okay, so in order to make further understanding on what prior period errors, let's look at illustration number 3. Okay. For example, here, an entity entered into a finance lease contract with a lessor to lease a machine with a fair value of 100,000 at the contract date, and the entity, however, recognized it as operating lease. Okay, so if you can still recall the difference between finance lease and operating lease, right? Finance lease, eventually the asset will be with us, right? Operating lease is not considered an asset or that the transfer is not, the risk and rewards is not transferred to the lessee, all right? But finance lease, the risk and rewards transferred to the lessee. So when they have mistakenly recognized this contract as an operating lease, so there is a implication to the financial statements. All right. So the effect of not capitalizing the finance lease may be material, right? Because there is a difference to record a finance lease and an operating lease. So the effect of not capitalizing the finance lease may be material, and this is considered an error. All right. So we need to do a retrospective application, that is changes in accounting policy. Now we will go into this again later on. All right. At this moment, what we need to know is that the impact of recognizing a finance lease contract as an operating lease is considered material, and we have to do an adjustment to that. Okay. So this is an example of prior period errors. Okay, now let's look at retrospective application. Okay, what does it mean by retrospective application? Okay. Now this one is relevant for change in accounting policies. Okay, meaning that you apply a new accounting policies as if that policy had always been applied. Okay, so for example, let's say you have decided to adopt the fair value model, okay, and the officers have overlooked that decision and continue to adopt the cost model when they want to record the investment property. Okay, so in this case, after several years, only that you recognize that the officers have made this error. So what we need to do is we have to make a retrospective application. We assume that the errors has not been made, so we have to do the adjustment. Okay, now if let's say, meaning that if let's say that we have the officers have not recorded the investment property for the last 10 years, so we have to make a retrospective application as if that there is no errors has been made. So we have to adjust from the day when they start recording the investment property. However, if you think that it is impracticable to determine the cumulative effect of the change in accounting policies, then the MFRS allows the company to record the errors as to account for the change prospectively. Okay, so basically, if you have made errors or change in accounting policies, okay, if you have change in accounting policies, if you have not done that change, you have to assume that you have to make adjustment, and you assume that the policy has always been applied, so make a retrospective application. However, if it is not possible for us to do that, then the standard allows us to adjust it prospectively. Okay, prospectively means that we do not need to adjust the transaction from the day when we have record that particular asset. We adjust it from the year that you have noticed the errors onwards. Okay. So to enhance your understanding, we can have a look at illustration number 4. Okay, so for illustration number 4, in 2007, the entity changed its accounting policy. The retained earnings as at 1st January 2007 before the changes in the accounting policy was 1 million. The cumulative effect of the change in accounting policy is a decrease of 100,000 in the retained earnings at 1st January 2007, the beginning of the current reporting period. Alright, so meaning that the company decided to change the accounting policy in 2007, and they take note that the changes, before the changes, the retained profit was 1 million. Then they find that the effect of the changes has made a decrease in the retained profit of 100,000. Okay, so what we need to do is we have to apply retrospective application. So we have to do adjustment from the day when they have when they record that particular transaction. Alright, meaning that they start adjusting from 2007 onwards. We start adjusting from the day we have made that particular transaction. Alright, so what we need to do is we have to adjust the retained profit brought forward. So the effect of the change in accounting policy must be presented as a restatement of the retained earnings as at 1st January 2007. Alright, so we know that the retained earnings on 1st January 2007 was 1 million, and we have to make that prior year adjustment because of the change in accounting policy by 100,000, and that makes our retained earnings at the beginning of the period to be restated to 900,000. Okay, so this is how we are going to record or adjust if there is a change in the accounting policies. Alright, we adjust as if that these errors has been made, as if that there is no errors, and we have made the adjustment from day one. Okay. Now let's look at prior period error. So we have done change in accounting policy. So we look at the next one, that is for prior period error, right? So if let's say there is a prior period error, what we need to do is we also have to do retrospective restatement. Okay, here what we do is we correct the recognition, measurement and disclosure of amount of elements of financial statements as if that there is no error. The prior period error had never occurred. Alright, so the same argument as change in accounting policies. We assume that there is no error, so we have to make the adjustment from the day the errors occurs, not the day when we realize the error happened. Alright, so we look at illustration number 5. Okay. In 2004, after the entity's 2003 financial statements were approved for issue, the entity discovered that as a result of computational error, depreciation expense for 2003 was overstated by 36,000, and assumed the balance return earnings at 1st January 2004 before the discovery of error was 100,000. So now they have given us the information that before the discovery of errors, the retained profit on 1st January 2004 was 100,000. Then they realized that in 2003, they have made an error in overstating the depreciation, 36,000. So based on retrospective application, what we have to do is we have to adjust the retained profit brought forward on the depreciation expense of 36,000, because we have to assume that there is no errors has been occurred. Right? So we adjust the 100,000 with the 36,000, meaning that our retained earnings at 1st January 2004 is actually 136,000. Now, why do we add this? Because 100,000 was after deducting the 36,000 when it shouldn't be deducted. Alright, so the 36,000 overstatement of depreciation expense in 2003, we consider this as prior period error. So the misstatements is caused by the mathematical error, and because of this, we have to make retrospective application. So we adjust the retained earnings as at 1st January 2004, okay, 100,000, and this 100,000 is after deducting the 36,000. So in order to rectify that, we add back the 36,000, so meaning that the actual retained profit at 1st January 2004 is restated to 136,000. So now we know that if there is a change in accounting policies or prior period error, then we have to make retrospective restatement, meaning that we make the adjustment from the day the transaction occur and not from the day we realize the mistake or the change in the accounting policies. Okay. Next, we go to the next application. We call it as prospective application. So prospective application only applies to change in accounting estimates. Okay. Now, when I say that only applies to change in accounting estimates, meaning that the MFRS states that for prospective application, only used for change in accounting estimates. But if you can still recall earlier on when we talk about change in accounting policies, alright, if change in accounting policies, like I mentioned just now, we use retrospective application, so we have to adjust from the day the transaction occurred and not from the day we make that decision of changing that accounting policies. However, so when it say, however, if let's say that it's impracticable for us to identify the cumulative effect of the change when we use prospective application. Okay, so meaning that prospective application, the standard allows us for change in accounting estimates. However, in certain situations where it is difficult for us to find the cumulative effect of the policy, change in accounting policy or errors, then the standard also allow us to use prospective application. Okay, so we look back at the change in accounting estimates. Now this one looks at the effect of the change is accounted for in the current period and future period. Okay, so assumption in applying retrospective application and prospective restatement when cumulative effect is impracticable to determine. So how do we do prospective application? Okay, so if we look back at retrospective restatement, we do retrospective application means that we are going to adjust all the cumulative effect arise from the change in the accounting policy. Right? So let's say, for example, in 2000, we decided to change the accounting policies in 2014. So, and we have adopted that policy since 2010. So what we need to do is we have to accumulate the effect from 2010 to 2014 and adjust that to our retained profit if it's affecting the retained profit. However, for prospective application, we adjust from the date of 2014 onwards. Alright, so that's the difference between retrospective and prospective application. Okay, so let's look at illustration number 6. An entity provides warranties at the time to purchases of its time of sale to purchases of its product. On 31st December 2005, an entity assessed its warranty obligation for products sold before 31st December 2005 at 100,000. However, the defect was discovered in June 2006, and in July 2006, the entity estimates the warranty obligation is 150,000 instead of 100,000. So when we provide provision for warranties, normally it is based on estimates. Okay, so now they say that the estimates that the provision for warranty should be 100,000. Then they realize that the provision should have been 150,000 instead of 100,000. So there is a change in the accounting estimates. So in this case, if you look at the solution, as a result of the defect discovery, the entity revised its estimate of its warranty obligation from 100,000 to 150,000. So the difference of 150,000 to and 100,000 resulting to 50,000 obligation, which has not been provided for 31st December 2005, is considered a change in accounting estimates for 31st December 2006. So what we need to do is, for 2005, we do not have to adjust for the change in the accounting estimates. We'll start adjusting at 31st December 2006. Okay, so meaning that from 2006 onwards, we are going to adjust 50,000, and then 2007, 2008 onwards. We do not have to adjust the prior period prior to 2006. Okay. Now let's look at the next one. We have completed the definition. Now we look at the accounting policies. Okay. Selection of accounting policies. Alright, so this one inform us on what do we need to do on how to select the accounting policies. Alright, so for accounting policies, what we do is we select the specific standard applies to a transaction, if any. Right? So let's say that certain items, we know that there is a specific accounting policies to that. Right? For example, for investment property, it falls under MFRS 140. So the standard have allowed the companies to either use the cost model or the fair value model. Similarly, for MFRS 116, the company is allowed to use either the cost model or the revaluation model. So if there is an accounting policies specifically cater for a transaction, then we have to use that accounting policies as stated in the MFRS, right? So meaning that if let's say that if we have a PPE, we cannot say that okay, we want to use the fair value model, because the standard doesn't allow us to use fair value model in MFRS 116, right? So if there is a specific standard applies to a transaction, then we stick to that policies. Yeah? For example, cost model is used to measure PPE. Okay. However, if there is an absence of specific standard, okay, then what we do is we base on judgment, so that the financial statement will be prepared is reliable and relevant. Okay. So what does it mean by management judgment? Okay. So management judgment refer to whether there's any standard for similar issue. Alright, so for example, if you say that you have a transaction that is not related to specific standard, so we use our judgment and see whether that it is related to that particular transaction. Let me show you one example. Let's say for MFRS 141 agriculture, alright, they have decided that, initially they have decided that all biological assets, right, should be recognized at fair value and be recorded in the financial statements. Alright, so for certain biological assets, for example cows or rubber trees, all those are considered as biological asset, but they do have fair value, meaning that they have a market value. If you want to sell it, we can actually sell it for at a price, right? But there are biological asset that is not appropriate to use fair value. For example, palm trees, right? Palm trees, after they bear fruits, at the end of the useful life, then they don't have a market price because the trees doesn't grow anymore. All right. So the question is, how do we determine the fair value of the palm trees if they don't have a market value? Of course, the standards says that there are possible ways to identify the fair value, but then the questions of cost versus benefits arise. So after further discussion and deliberation by the the Malaysian Accounting Standards Board, then they decided that certain biological assets do not need to be recorded at fair value. Alright, so for example, these palm trees, what they do is, instead of recognizing it under biological asset under MFRS 141, they decided that this kind of biological asset should be recorded under MFRS 116 because it possesses similar characteristics to PPE. Alright, so if let's say that palm trees is not applicable to MFRS 141 because of the different characteristics, so based on a judgment, we find a standard that is quite similar to that issue at hand. Alright, and then we resolve it that way. Okay. If let's say there is no standard for similar issue, we look at any other related concept for recognition criteria and definition in framework that relates to that issue. Okay, so the standard have actually allowed us to value or to evaluate that particular transaction or issue, and then see whether we can refer to any other standard, Otherwise, we refer to any concept for recognition criteria and definition in framework that relates to the issue. And let's say that we still couldn't find an answer to that. Then they say that why don't we look at the standard issued by other setting bodies, for example, the FASB in the US, and also at other accounting literature and accepted as industry practices. Alright, meaning that we try and find solution by reading, by referring to the previous by referring to the other standards that is provided by other setting bodies, and if can't, then we refer to the other accounting literature and accepted as industry practices. So the reason is it doesn't matter. Okay, if you don't have a specific standard, you rely on this way. You try and find the solution we are using by referring to this way, and if you can't, try and make a decision or judgment on what is the most appropriate solution to that particular issue at hand, right? As long as the financial statement prepared is relevant and reliable in making decision. Okay, so once you have decided that, okay, we are going to adopt this particular transaction based on this particular standard because of the similarities, then you have to be consistent in applying that standard, right? So entity apply the accounting policy consistently for any other similar transactions. Okay, so let's look at illustration number 7. Okay, now this is illustration number 7. On 1st January 2007, as part of the scheme to provide support for projects to help rural communities, a non-government development agency announced a plan whereby during 2007 and 2009 entities, they can apply for a grant to set up farming operations in a specified rural areas. Qualifying entities will receive an upfront cash payment for 50,000 to set up farming operations in the specified areas. Entities must complete an application form, submit the proposal, and provide specified documents which the development agency will consider before issuing the grant. Okay, basically the standards allow us, the standard does have a standard that take into account grant received from government, right? But they don't have a specific MFRS that account for grants that receive from non-government agency. So in that case, which MFRS or how are we going to deal with this issue, right? Because of the absence of MFRS for grants received from non-government grants, so what we need to do is we have a look, we try and compare whether it can be accounted under standards that refers to government grant, right? So if you look at the solution here, the MFRS does not specify how to account for a grant from non-government grant, a non-government development agency, but it does specify how to account for government grant. So by analogy, the grant received from non-government development agency should be accounted with accordance to MFRS 120, that is, the entity should determine its accounting policies for grants from non-government development agencies in accordance with the requirements of MFRS 120, which is MFRS 120 accounts for transaction related to government grants. Because of the similarity, then we say that, okay, we can actually use or refer MFRS 120 to apply for grant from a non-government agency. Now, next one is referring to change. Now, when do we require a change? Okay, so it's either because of requirement of the MFRS, right? For example, change from using the cost model to a fair value model, or change from using the fair value model or to cost model, Or in the context of the MFRS 141 agriculture, a change from recognizing fair value on all types of biological asset, now change it to certain other particular types of MFRS to suit the characteristics of one particular biological asset. Or we need to make a change if it result in a more reliable and relevant information provided in the financial statements. Okay, only then we can make that change. Other than that, we cannot change if it's accounting policies for new type of transaction. We are not allowed to make a change, right? Or a change because of a new accounting policies for new transaction, then it's not considered as a change. Or first time revaluation on assets under MFRS 116 and MFRS 138 intangible asset, because this is not considered a change, it is considered as a first time adoption. Okay, so we can only make a change if it's required by the MFRS, and also because if it provides a more relevant and reliable information. Okay, other than that, it is not considered as a change. Okay, so if you look at illustration number 8, an entity acquired an investment in an associate in the current accounting period and adopted the cost model. An entity acquired an investment in associate in the current reporting period and adopted the cost model to measure the investment in associate after initial recognition. It had never before held an investment in an associate, right? Meaning that they acquired that investment in associate, and it is the first time for them to acquire this, considered as a new transaction. So we don't consider that as a change, because in fact there is no change, but there is only a new recording of new transaction. So the adoption of cost model to measure its first investment in an associate does not constitute a change in accounting policy, because this transaction has not been engaged before. Alright, so in this case, it is not considered as a change. Now, in relation to accounting treatment, if it's retrospectively, meaning that we have to adjust the opening balance of the retained earnings, as what we have presented before. Alright, so the retained earnings at the beginning of the period, we have to adjust to account for the cumulative effect of the change of the accounting policies, or the change in, or because of prior period errors. So adjust the opening balance of retained earnings and also adjust to the related accounts. Alright, for example, if you have made a mathematical error, casting error on the sales, then you have to just adjust the sales account, and you also have to adjust the retained profit opening balance, because it affects the retained profit. Okay. Now, comparative can be restated, should be restated unless it is impracticable. And if let's say we cannot use retrospective for that particular transaction, then because of impracticability, then we have to use prospective application. Okay. Now this one relate to disclosure. Alright, meaning that once you have made that change, you have to make a disclosure in the notes to accounts. Alright, explaining why do you need for the change. Okay, the reason for change, the amount of the adjustment that you have to adjust, the amount of adjustment for prior period, that is the amount that you have adjusted for the cumulative effect, and also to disclose comparative between the years. Okay, but this is only if it's practical. Otherwise, you don't have to do that. Now, if it's related to change in accounting estimates because of new information or more experience or by nature, then this change in estimates, for example, changes in estimated useful life of assets, bad debts, inventory obsolescence, and warranty obligation, So this change is considered prospective. Alright, so we do not have to adjust the retained profit brought forward, nor do we have to put into account the cumulative effect. Okay, so with the accounting treatment, prospective application. So in the current year, if the change affects current year only, okay, example, estimation of bad debts. So once you don't have to change the previous year, and you also don't have to change the future years, right? Because the effect only affect the current year. Okay. In current and future, if necessary, for example, changes in the useful life of asset. So because of changes in the useful life of the asset, then we have to, the amount of depreciation charged on that particular asset will be different. Then it will affect not only the current year, but also the future years. So in that case, you have to make adjustment for the current as well as the future period. Okay, so we look back at question number 6. Illustration number 6. Okay, this is an example where you do prospective application that you have to change. If this change of 50,000, the difference between 150,000 and the 100,000, the 50,000 only provided in 2015, in 2005. So the adjustment will only be recorded in 2006. So if it does not affect the provision in 2007 and 2008, so we do not need to make adjustment for that 2007 and 2008. Alright, so we only adjusted that once. Now we go back to errors. Now errors occurs because of mathematical mistakes, right? We have make wrong calculation or casting, mistakes in application of accounting policies, right? For example, we have decided to use fair value model for investment property. Suddenly, we didn't realize that decision, and all this while you use the cost model. Misinterpretation of facts because of you don't really understand what the content of the transaction. Oversights of facts, and fraud, that is an intention to commit an illegal action. Okay, so how do we treat it? For prior period errors, we do a retrospective restatement, as what have been presented earlier. Okay, so we restate the comparative, restate the related accounts, but if we can't make the prospective application, then we apply the prospective application. Alright, so let's say that we have realized the errors, but we can't make comparative, or we cannot determine the cumulative effect, then we don't have to do the retrospective application. We just do the prospective application. So if it's related to errors, okay, so these are the things that you need to disclose. Okay, nature of the error, the extent or the amount of the correction, and provide reason if you can't apply retrospective application. Okay. Okay. So for MFRS 108, what you need to know is you need to know what does it mean by accounting policies, what does it mean by changes in accounting policies, and what does it mean by prior period errors, and how do we account for that? Alright, so you need to understand the difference between retrospective application and prospective application, and in what circumstances we use retrospective application, in what circumstances we use prospective application. So as a summary, you can say that for those change in accounting policies and for those errors, alright, prior period errors, then we have to do retrospective application. That is, we find the cumulative effect of the change or error, and then we adjust our retained profit brought forward. If, let's say, it is related to change in accounting estimates, then we only adjust prospectively. That is, we adjust the current year retained profit, and we don't disturb or we don't adjust the previous year retained profit. So we adjust the current year retained profit if it's relevant to the current year, and, for example, provision of warranty. And we adjust the current and future year if it is affect the future as well. For example, estimation of depreciation. Okay, so in that case, it affects not only the current year, but also the future year. To further enhance our understanding on MFRS 108, let's have a look at the past year's questions. Okay, now the purpose of doing the past year or attempting the past year's question is because to test our knowledge on whether we understand the concept applied in MFRS 108, to understand whether that particular transaction is a change in accounting policy or a change in accounting estimates or because of prior year errors. Okay, we look at question number 1. Alright, so in this question they ask us to identify the transaction, the following transaction, whether it is an accounting estimates or a change in accounting policies. So they have given us 3 transactions. So for first transaction is estimating that 5% of the accounts receivable are uncollectible. So this is considered a transaction in change in accounting estimates. Okay. Now, the second transaction, Chera recognized income arising from service contract on the basis of the stage of completion. So, meaning that now they decided to change the accounting policy. Right. So, this is considered as a transaction relevant to a change in accounting policy. C. Chera Berhad determines that it will adopt the fair value model for the measurement of its investment property. So this is also an example of a change in accounting policies. Right? D. The current year warranty provision is calculated by providing 1% of current year sales based on last year's warranty claims amounting to 1% of sales. Now this is considered as a change in accounting estimate. So we have to provide 1% of current year sales based on last year. So claims amounting to 1% of sales. So the change of the provision. So this is considered as a change in accounting estimates. Okay. Now we will have a look at question number 2. Chera have a building which it purchased on 1st January 2009. The building has been depreciated on a straight line basis over its useful life. And then at 1st January 2014, the remaining life of the building remains 10 years. Then in 2014, they reviewed back the depreciation policy for similar buildings and they decided to depreciate over a longer period of which is 20 years. So as at 31st December 2013, the building has been used for 5 years and the details of the building are as follows. They have the cost of 9 million, accumulated depreciation of 3 million resulting in a carrying value of 6 million. So they ask us to determine the change in useful life of the building, whether it is an change in accounting policy or change in accounting estimates for Chera in accordance to MFRS 108 accounting policy, changes in accounting estimates and errors, and the change in the useful life of the building is considered a change in the accounting estimates since it cannot be measured with accuracy and therefore it involves judgment based on the latest reliable information. Next, they ask us to compute the total amount of annual depreciation before the economic life changes. Before the change in the economic life, the cost is 9 million and they have a useful life of 15 years. That resulting in the annual depreciation charge of 600,000. Calculate the revised annual depreciation based on the remaining life of the asset for the year ended 31st December 2014. So, since the total useful life is reassessed as being 20 years and 5 years have already elapsed, meaning that the remaining useful life is 15 years. So remember, initially it was 15 years, then they have used up for 5 years, so meaning that they have already used, the remaining useful life is 10 years. So when they revise back to 20 years, and they have used up 5 years, it comes back to 15 years. Okay, so 20 years minus 5 years equals to 15 years. So the revised annual depreciation for the year ended 31st December 2014 and future year will be 9 million minus 3 million. You have divided by 15. So your depreciation per year is 400,000. With reference to MFRS 108 accounting policies, changes in accounting estimates and errors, discuss the appropriate accounting treatment of the above information situation. So changes in accounting policies, we have to adjust it prospectively, alright? So in the period in which the estimate is amended and to future period, okay? So in future period, depreciation expense will be 400,000, whereas if we refer back in 2013, it used to be 600,000. So now, because of the change in the accounting estimates, the depreciation charge is 400,000, and then we do not have to find a cumulative effect of the change, nor do we have to make comparative figures because the change is considered a prospective application. Okay. Now we look at question number 3. The following are independent transactions relating to changes in accounting policies, changes in accounting estimates and errors. So they ask us to identify whether this transaction is a change in accounting policy, a change in accounting estimates, or errors. Right. So if you look at transaction number A, a machinery costing 60,000 and the residual value of 3,000 was acquired on 1st July 2011, and depreciation on a straight line basis over 15 years. So as at 31st July 2014, remaining useful life was revised to 10 years with no residual value. So this machinery initially costing 60,000 and they have a residual value of 3,000. Alright, now the useful life is 15 years. So when we calculate the depreciation, it should be based on this value. Okay. However, on 2014, they say that the remaining useful life has been revised to 10 years with no residual value. Okay. So for the so they ask us to determine whether the above situation is a change in accounting policy, a change in accounting estimates, or errors. So back to the coming back to number 1, so this transaction is considered change in accounting estimates. Okay. B, a sum of 500,000 collected from trade receivable was misappropriated by one of the senior management staff in May 2014, and this was only discovered in June 2015, and no adjustment has been made to rectify the losses due to fraud. Right? So when it comes to fraud, meaning that it is a prior period error because this transaction happened before June 2015. So this is considered a prior period error. C, payment to trade payables amounting to 150,000 in April 2014 was wrongly recorded as a repair and maintenance. So again, this is an error occurs. So this is considered as prior period error. Okay. So we go to the next one. For each of the above situation, explain whether the application of the change should be done retrospectively or prospectively. So if you can recall the notes that we have referred to just now, for change in accounting estimates, it should be recorded prospectively. Okay. For prior period error, right, for B and C, because they are prior period error, so it should be recorded or adjusted using retrospective application. Now we go to the last part, that is prepare necessary journal entries to rectify the situation above. So journal entries for the change in accounting estimates, right? So we'll debit depreciation for 860 and credit accumulated depreciation for 860. So how do we obtain that figure? That is, we have to find the carrying amount of the machinery as at 30th June 2014 when they changed the useful life. So 60,000 minus 11,400, which is obtained by 60,000 minus 3,000 divided by 15 times 3. So you obtain 48,600 as the new value or new carrying amount of the machinery. So you divide by 10 years. So your annual depreciation is 4860. Okay. Now for transaction number B, where you can recall about the trade receivables, right? Misappropriation because of the fraud. So that amount shouldn't be there. So we reduce the amount of account receivable and we adjust back the retained earnings. So we debit retained earnings 500,000 and credit account receivable 500,000. Okay. C is related to payment to trade payables, right, which is wrongly recorded in the repair and maintenance. So what we need to do is we adjust the accounts payable 150,000 to rectify the error, and we credit 150,000. Okay. Now let's look at question number 4. On Hijau involved in manufacturing of computer chips. For the year ended 31st December 2014, the company encountered several situations. So again, we have to identify each of the transactions, whether it is a change in accounting policy, change in accounting estimates, or errors. So if you look at information number 1, in January 2014, Hijau discovered some of the inventories sold in 2013 were included in the inventories for the year ended 31st December 2013. In this case, the inventories on that date were overstated by 200,000. So meaning that this is a prior year error, right? So the situation of that particular transaction is considered a prior year error. Now we go to number 2. Hijau acquired a machine costing 10,000 on 1st January 2012, and the depreciation and the machinery are depreciated based on straight line method over 10 years. Then, due to heavy usage, the remaining useful life of the machine was revised to 4 years. Now, this is considered as a a change in accounting estimates. First, they expect that it can be used for 10 years. Then, they say that, okay, it has been reduced to 4 years. So, the result is a change in accounting estimates. Number 3, Hijau acquired a plant in 2011. Due to proper maintenance of the plant, no depreciation has been provided. The annual depreciation charge per annum should be 2,000, meaning that they should have charged 2,000 to that plant, but they did not do it. So this is considered as a prior year error. Alright, so a prior year error. Number 4, Hijau changed its method of valuing inventory from the first in, first out method to the weighted average method, meaning that they changed the accounting policy from using this method, first in, first out, to average weighted average method. So the answer is change in accounting policies. Okay. Now the answers for situation 1, 2, and 3 above. Prepare the relevant journal entries for the year ended 31st December 2014. So let's go back. So number 1, because of the overstatement of the inventory by 200,000. So when we do adjustment, then we debit retained earnings 200,000 and you take out the 200,000 figure from the inventory because it shouldn't be in the inventory. So we credit inventory 200,000. Number 2, when they acquire and they revise the useful life. So this is a prior year estimates. So you do the prospective application So we debit statement of profit and loss, depreciation 2,000, and credit accumulated depreciation 2,000. Number 3, if we can recall back, this is an error made by Hijau for not recording the 2 million depreciation. So we have to adjust the depreciation. So we debit statement of profit and loss 2 million and credit accumulated depreciation 8 million. So resulting retained earnings of 6 million. Okay. Now we go to the last part of our topic today. On 1st January 2013, Mera sold a plant with carrying value of 200,000. Then the only record made by the account assistant was the sale proceed of 275,000 credited to the sales revenue. So this is considered as a disposal of plant, but the officer have wrongly recorded it into the sales revenue for the year ended 31st December 2013. And this was only discovered in 2014, and the retained earnings as at 1st January 2014 was 8 million. Alright, now first we have to determine that this is a disposal of plant of which it shouldn't be recorded in the sales revenue account. Okay, so there is an error here. So this is considered as a prior year error. So what we need to do is we have to adjust the retained earnings as at 1st January 2014 on the effect of the error made by the officer or the accounts assistants to the company. So A, discuss the proper accounting treatment of the above situation in accordance with MFRS 108 accounting policy, changes in accounting estimates and errors. So what you need to do is you have to adjust the adjustment this as because it's a prior year error, so we have to adjust it based on retrospectively. So that sales shouldn't be in the retained earnings, so we reduce that the balance of the retained earnings by 200,000. So we debit retained earnings 200,000 and credit 200,000. Because it's a disposal, so basically the plant account should have a credit item of disposal of 200,000. And to restate the retained earnings, we know that the balance as at 1st January 2014 is 8 million. Okay, and then we adjust back with prior year adjustment to 200,000. So that comes to our restated retained earnings of 7.8 million. Okay, so I hope by doing all these questions will enhance your understanding on MFRS 108. Right, so the only thing you need to know for this particular MFRS is the difference between change in accounting policy, prior year errors, and change in accounting estimates, and how do you account for these three transactions. Alright, so if it's change in accounting policy and change and prior year error, then this change and prior year error should be accounted retrospectively. Okay, if you cannot, well, what does it mean by change in retrospectively? It means that you have to adjust the financial statement as if that the change or the error has not occurred. So let's say that if you have made an error in 2012 and you only realize in 2015, so in your financial statement of 2015, you have to make all the adjustment accounting for the error or the change in accounting policy from 2012 onwards. Alright, so but there are circumstances where they don't allow us or it is impracticable for us to make that cumulative effect or the change in the cumulative effect. Then in that case, we apply prospective application. And if it's a change in accounting estimates, then we adjust using prospective application. Now in prospective application, what we need to do is we have to adjust the current year, if it's relevant only to the current year, and if it's also relevant to future years, we adjust to the future years as well. Okay, so that's all for MFRS 108. So till we meet again, Assalamualaikum and thank you.